Hi, everyone, and welcome back. Our next speaker for this morning is Tony Cousins. Tony is the co-CEO and co-CIO at Perfect International. He's also a portfolio manager on the Ned Group Investments Global Cautious Fund. Tony, a very warm welcome to you. How are you?
I'm fine, thank you. Great to be here.
Yeah, great having you here. Thanks so much for sharing some of your time and insights with us. I mean, Tony, I think as we were mentioning, Q1 was a very interesting quarter, but the kind of first 2 or 3 weeks that we've seen of Q2 already has probably been more interesting and more volatile with a lot more noise around it. But perhaps if we can please start about talking about returns for the past year up until 31 March and what drove those returns, please.
Sure. Yeah, well, the Cautious Fund delivered very slightly over 7% positive return for the year up until the end of March, coming from positive returns from both bonds and equities. Equities did outperform bonds over that annual period, delivering performance of 9.7%. Bonds delivered 5.4%. We saw stronger returns out of US bonds compared to non-US bonds, but that was reversed in the equity markets where non-US dollar equities actually outperformed US bonds. Pleased to say that those are the results for the fund, and in all the categories, both non-US and US bonds and equities, the securities owned in the Cautious Fund actually outperformed the passive index over that 1 year period. So we picked the right markets, we picked the right stocks and the right duration of bonds. So this is a cautious product. It is limited in how many equities it can hold. But I think we have navigated the volatility pretty well.
Thanks, Tony. I think you definitely have from the numbers that I've seen. Just kind of turning to the fixed income space for a moment and looking at yield spreads. What are you seeing at the moment there? I think yields have blown out a little bit or started to move wider. What are you seeing in that space at the moment, please?
Well, there's lots of different things going on. I mean, one of the slides we're showing in this presentation is Japanese bond yields against Chinese bond yields, which have crossed over, which if someone had said that was going to happen a year ago, nobody would have believed them. I guess there's a lot of action going on in the US where, and I think really this is one of the main things that has caused the administration to reconsider the initial tariffs that they imposed. We've seen some sharp rises in Treasury bonds, in Treasury bond yields. And quite interestingly, we've seen some widening of credit spreads in the US, particularly at the high yield end. Now, that is traditionally an indicator of a slowdown, if not a recession. And we've seen the spread for triple C bonds year to date push out by 270 basis points. That's a lot. And this is really market concerns about the effects of tariffs on the US economy. They will certainly cause a slowdown. Will they actually cause a recession? Well, folks are very worried about that. On the inflation side, tariffs are inflationary. They have been left on for China, which is worth about 0.7% per annum on CPI, where they are now. Who knows where they'll be tomorrow? But that's where we stand right now. So you've got some upward pressure on yields coming from worsening inflation expectations in the US, and you've got some upward pressure on spreads coming from worries about recession in the US. Over in Europe, it's very interesting. We saw rises in German yields when they announced the enormous defense and infrastructure package, which would be financed by borrowings. But markets have calmed down and these yields have retraced back to where they were around about the beginning of the year. So markets are obviously more sanguine about lending money to Germany than they are to the US right now.
I mean, as if yield spreads are not enough to keep you up at night. What about duration? I mean, managing duration is tricky during normal market conditions, and from what we're seeing now, it becomes even more tricky.
Absolutely, and we have a very low duration on bonds in this portfolio to come back down to 3. We have raised it, and that's how this product works. We set trigger points whereby we will raise duration. We did so during the quarter, and that's on one of the slides that we have in this pack. But then when yields came down again, we reduced duration back again to a very low level of 3 years. And that's where we are now. Now, those yields have gone back up. We are approaching our trigger points, which are closer to 5% on US Treasuries, at which we will increase duration again. But the simple principle here is you only take duration risk when you've been paid for it. And at the moment, you're not being paid enough for it. If those yields get up to 5%, we would move it up again. And if they kept on going, we would increase it further. But we've seen in the last few weeks in long bonds in the US, which have seen the brunt of the yield rises, capital losses of high single digits. If you've owned the 30-year bond, you've lost 9 points of capital just since these tariffs were put in place.
And Tony, something you kind of briefly mentioned just now was the comparison in bond yields between China and Japan, and China literally one of the central targets in Trump's whole tariff plan. What are your thoughts on that, please?
Well, the decline in bond yields in China is really reflecting the effect of tariffs. China has taken a very tough stance against tariffs and introduced retaliatory tariffs, and this will hurt everybody, but it will hurt the Chinese economy, and bond yields are reflecting slower growth coming out of China. Interestingly, in Japan, you've seen exactly the opposite happen because Japan is seeing inflationary pressures coming through. We did a study of this about 18 months ago, which looked at the effect on the labor force in Japan. Wages are rising at mid-single digits, around about 5% in Japan, and they have really exhausted all the measures that they've had over the last couple of decades to deal with a declining labor force. They outsourced manufacturing overseas to take advantage of greater capacity there. There's a limit how much of that you can do. They increased working hours. They increased female participation rates. They increased the effective retirement age of workers. But all these are finite measures, and they really run their course. So what we're seeing now is the effect on the Japanese economy and Japanese industry of a shortage of workers, which they can't really add to, and that is returning inflation to the Japanese economy, and that's what's been reflected in bond yields, which were held, artificially low by JGB buying by the central bank for many years, and now they're being allowed to rise, and as we see in the chart, have actually risen above the Chinese bond yields.
And Tony, I mean, something you have started talking about already, but just more of your outlook on policy, prospects for economic growth. I mean, how this whole tariff thing can unwind. I mean, look, things can literally change by this afternoon, but yeah, how are you seeing things at the moment?
Well, I think mainstream economists would say that tariffs are just bad news. They lower growth and they raise inflation. And some of the great disinflation the world economy has seen over the last 2-3 decades has come from globalization and increased trade. And this is economics free trade textbook 101, isn't it? Comparative advantage works. And the US may harp and complain about its budget, its trade deficit, but the US has hardly grown poorer over these few decades. It's the richest major economy on the planet, and has done very well. And what we've seen in the US is reallocation of capital away from either labor intensive or what you might call sunset industries like steel and aluminium and shipbuilding, etc., which have gone to lower cost labor countries. But the capital that was devoted to them in the US has been reallocated to much more capital light, higher return on capital businesses. And we just need to look at the Magnificent Seven tech companies to see that at work and the dominance that they have been able to gain. So I think for the US to claim that it is being ripped off is nonsense. And the absolutely laughable way that they've calculated the effective tariffs from other countries is, it's gobsmacking. This doesn't indicate that the grown-ups are in charge, I'm afraid. This has all the signs of Peter Navarro, who is the special trade advisor to the president, and he is a follower of fringe economic policies. He's not mainstream, and the idea that the US is going to become the leader in steel and aluminium and shipbuilding again is just rather bizarre. They've done very well out of the shift in their economy over the last 40 years or so, and trying to reverse that is incredibly disruptive and won't succeed.
Yeah, I mean, Tony, just perhaps the last thing before I let you go is if you can please take us through some of the details of how the portfolio is actually positioned at the moment, given everything you've just said and what we've been talking about, please.
Sure, yeah. The bond weighting is 77.3%. This was at the end of March. Equities at 20%, and a little bit of cash. We did sell out of Canadian bonds in the quarter. They just weren't yielding enough, and the yield discount wasn't being justified by the inflationary outlook. So we sold those and redistributed those amongst the US, UK, and Australian bonds, which are giving you more attractive yields. In equities, we've had a very underweight position in dollar US equities, purely on valuation basis. Fine companies in the US, but they're just too expensive. And there's been a great preference for within the non-US part for Asian equities, but obviously there's significant, you don't put it all in Asia, so there's been a significant weighting into Europe, which has benefited from some, perhaps prematurely, are saying is the end of US exceptionalism, and we've seen Europe in particular outperform the US by a significant margin this year. I think the thing we probably should particularly remark upon is the currency positioning of the fund. We have a limit of no more than 45% of total assets exposed to unhedged foreign currencies, and we're right up on that because the dollar, despite its fall, remains the most expensive currency on the planet, and we think this dollar decline has quite a long way to go. If you look at the appreciation of the US dollar over the last 15 years up till the end of 2024, in real trade-weighted effective terms, the dollar appreciated by around about 41%. So its decline by about 5% from that peak is really quite small. So we think there's more of this to go. Certainly, the administration in the US want that to happen. They see that as another way of reducing the trade deficit. They actually have some logic on their side here because the dollar is such an expensive and overvalued currency. So we can see more of that happening, and we will be happy to maintain this high unhedged non-dollar exposure within the portfolio. But the overall equity weighting remains pretty low. We're capped at 40%. We're only half that. The duration remains very low. Again, because you're not being paid enough for it in the fixed income portion of the portfolio. But these things can change. When the facts change, you change your point of view, and that is what we will do. And we preset trigger points, and whenever any of these are hit, we convene the investment strategy committee meeting within 24 hours. It's not an automatic decision to act, but I've been here 36 years, and we have never failed to act when one of those trigger points has been hit.
Tony, that was very comprehensive. Thank you so much. Such deep insights and so interesting. Really appreciate having you here.
Yeah, it's always great to speak to you. No one's more important than our clients. And if there are any questions, we're very happy to get back on the line and talk to you.